In today's video, we are going to see ICICI Prudential AMC. It was established in 1993, but in 1998, Prudential PLC came in as a joint venture partner. At present, ICICI Bank holds 51% stake in the JV and Prudential holds 49%. ICICI Prudential Mutual Fund offers 229 mutual fund schemes, which comprises 45 equity schemes, 140 debt schemes, 15 hybrid schemes, and 29 other schemes. If you see the AMC, then the asset under management is 4,97,269 crores. It holds 83 number of schemes and the AMC age is 29 years. We are going to see three best equity funds from ICICI today, which includes ICICI Prudential Small Cap Fund, ICICI Prudential Technology Fund, and ICICI Prudential Infrastructure Fund. So let's start. So the first is ICICI Small Cap Fund with an AUM of 4,235 crores. It was launched on 1st of January 2013 and the expense ratio is 0.82%. You will have to pay 1% exit load if you exit in 365 days. The minimum SIP is 100 and the lump sum is 5,000. There is no lock-in in this particular fund. This fund is good for long-term investment and the benchmark it follows is Nifty Small Cap 250 TRI. If you see the portfolio, then it holds 54 number of stock in the portfolio with 90.13% in equity, 0% in debt and 9.87% in others. If you see the allocation by market cap, then they are investing 2.29% in large cap, 5.93% in mid cap and 81.99% in small cap. If you see the allocation by sector, they are investing 21.13% in services sector, 12.66% in healthcare sector and 12.34% in capital goods sector. If you see the allocation by stock holdings, then they are investing 4.27% in Rolex rings, 3.59% in Inox Leisure, 3.38% in CCCL products and 2.74% in KMSL. Okay, if you see the standard deviation, it is highly volatile, which is 19.99 versus 90.7 of the category average. The beta is low volatile, which is very good, that is 0.7 versus 0.8 of category average. If you see the SAPE ratio, it is giving better risk adjusted returns and alpha also it is giving better risk adjusted returns. If you see the portfolio tenure, it is more frequent, which is 36% versus 30.4 of category average. So in this scenario, the fund managers are changing the stock frequently, which is not good because it adds extra charges to the fund and it comes to the investors, right? If you see the downside protection, then this fund is giving very good downside protection, as we can see in the 1 month period, 3 months, 6 month volatility and 1 year, where we don't see any red mark over there. That means there is no negativity, there is no negative returns given by this particular fund, which is very good. Okay, if you see the 1 year return, then this fund has given 8.79% in 1 year, 31.86% in 3 years, 14.77% in 5 years and 17.25% since its inception. If you would have done an SIP of 10k, that is 10,000 per month for the last 5 years with a step up of 10%, then this fund would have given you 11.58 total value with a profit of 5.58 lakhs. That is actually coming to 26.28% annualized returns. If you see, or if you compare this with EPF, PPF, bank FD and savings, obviously gold also, then these particular returns are very high, as we can see from the data, right? Now if you see the fund returns, then this particular fund has given a return of 8.51% in July 2022, which is greater than 8.45% of the benchmark. So it has beaten the benchmark. But in August 2022, it has given only 2.47 versus 3.93. So it is not able to beat the benchmark there. But again in October 2022, it has given 0.88% versus minus 1.24% of benchmark. So it is continuously trying to beat the benchmark. But yes, as we can see the market conditions, it is not continuously possible to beat the benchmark. But even in this scenario, it has beaten the benchmark in July and October. That's a very good sign. Now imagine that this particular fund is giving you 17% returns for the next 30 years and you are investing in this fund. Then in that scenario, for 20 years, your investment is going to be 24 lakh and the returns which you could expect would be 1.78 crores and the total would be 2 crores. If you invest in this particular fund for 30 years, then your investment amount is going to be 36 lakhs. Estimated returns could be 10.89 crores and the total, including the invested amount plus estimated returns, would be 11.25 crores. So this was regarding ICICI Small Cap Fund. The second fund is ICICI Prudential Technology Fund. It is a sectoral kind of fund with an AUM of 8,693 crores. It was launched on 1st of January 2013 and it has an expense ratio of 0.87%. You will have to pay 1% exit load if you exit in 15 days. You can start an SIP with 100 per month and you can start a lump sum of with a one-time amount of 5,000. There is no lock in this particular fund and this fund is good for long-term horizon. It follows a benchmark which is S&P BSE Tech TRI. If you see the fund portfolio, it is holding 49 number of stock in the portfolio, and they are investing 93.72% in equity, 0.11% in debt, and 6.16% in others, which includes cash as well. If you see the allocation by market cap, then they are investing 70.52% in large cap, 4.39% in mid cap, 5.48% in small cap, and the best part is that they are investing 4.94% in foreign equity. If you see the allocation by sector, they are investing 75.57% in technology sector, 8.67% in communication sector, and 7.06% in services sector. If you see the allocation by stock holding, they are investing 28.71% in Infosys, 15.79% in TCS, 9.91% in HCL, and 7.13% in Wipro. If you see the standard deviation, it is highly volatile. If you see the beta, it is again highly volatile. If you see the Sharpe ratio and if you see the alpha, they both are very good because they are giving better risk adjusted returns. That means investors who are putting their money, they are getting the benefits of this particular thing because the fund managers are working very hard to create extra benefits or returns for the customers. If you see the portfolio turnover, that is again very good, which is just 77% versus 144.7 of the category average, which is less frequent, which is a very good sign because the fund manager are holding the stock or bonds in the portfolio for longer duration than its peers. If you see the downside protection, then IT is a sector which is going down since last 1 year, as we are seeing because of the market scenario, and this particular fund does not offer very good protection in 6-month period, YTD period, and 1 year period, where the fund has fallen 4.05%, which is positive. This particular fund has fallen -76% in 6 months period. In YTD, it has fallen -22.57% compared to 2.46% of the category average, and in 1 year period it has fallen -15.40%. So in 1 year it has given -15.40% return. In 3 years it has given 35.64% return. In 5 years it has given 27.33% return, and since inception it has given 22.66%. The only one thing which I would tell to the investor is that since it is an sectoral IT stock, especially means it invests in IT stock especially, you have to make sure that you have to stick to this particular mutual fund for longer period, and please don't exit and don't panic because of this current situation. The situation is going to go good very nicely over a period of time. As we can see, US Fed has increased the rates, but the rate what expected, which is 0.73, and which is under the range. So going further after a quarter or so, you will see the rates will come down. Definitely the US Fed is going to come down, and that would really help the market. And from that particular period, once the rates are coming down, then we will see the market will go like anything, and there would be a good bull run. So please hold on to your investments, whether it's stock or it's mutual fund. Don't sell your IT stocks, where especially the good stock like TCS, Infosys, L&T, right, or others basically. So you have to keep patience. We know that the market is going down, but then if you don't keep patience, you won't be able to make money. So hold on, please. Yeah. So let's move ahead. If you would have done a monthly SIP of 10,000 for 5 years with a step of 10%, then in the last today your value would have been 11.55 lakh with a profit of 5.55 lakh, and your annualized return would have been 26.17%. If you compare this with EPF, PPF, bank FD, savings, and gold, this is definitely better. Yeah. Now if you see the benchmark, then in July this fund has given 4.06% compared with 9.49% of benchmark. In August it has given -0.98% versus 3.22% of the benchmark. Yeah, and in October it has given -3.50% versus -2.51% of the benchmark. So this is how the current scenario is, but this scenario is going to change very soon. As I can see, I have been investing in ICICI technology fund since last 9 years, and this fund has given me very good returns. So stay invested in whatever technology fund you are, because technology is the future. It is going to grow like anything. Okay. Now imagine that this fund is given 22% return for the next 20 years. Then in that scenario, your investment for 20 years is going to be 24 lakhs. Your estimated returns could be 4.05 crores, and the total including invested plus estimated would be 4.29 crores. And if you keep on investing for 30 years, then your invested amount is going to be 36 lakhs. Estimated returns could be 38 crores, and the total could be 38.40 crores. So this was regarding ICICI Technology Fund. The third and the last fund is ICICI Infrastructure Fund. This is a sectoral kind of fund, and it has an AUM of 2026 crores. It was launched on 1st of January 2013 and it has an expense ratio of 1.69%. You will have to pay 1% exit load if you exit in 15 days. The minimum SIP is 100 per month and minimum lump sum is 5,000. There is no lock-in in this particular fund, and this particular fund is good for long-term horizon. It follows the benchmark, which is S&P BSE India Infrastructure TRI. If you see the particular fund portfolio, then it holds 15 number of stock in the portfolio and investing 94.34% in equity, 0% in debt and 5.66% in others, which includes your cash as well. Allocation by market cap, if you see, then they are investing 49.97% in large cap, 11.42% in mid cap and 23.77% in small cap. If you see the allocation by sector, they are investing 24.78% in financial sector, 21.77% in energy sector and 14.38% in construction sector. If you see allocation by stock holding, they are investing 9.22% in NTPC, 8.67% in L&T, 7.31% in Airtel and 5.57% in ONGC. If you see standard deviation, it is highly volatile. If you see beta, it is highly volatile. If you see the Sharpe ratio, then it is giving better risk adjusted returns. Alpha also is giving better adjusted returns. And if you see the portfolio turnover, it is less frequent. That means the fund manager are holding the stock in this or stock or bonds. If they are purchasing, then they are holding the stock and bonds in the portfolio for longer duration than the peers. So Sharpe ratio, alpha, both are very good. The portfolio term is very good. If you see the downside protection, then this particular fund is very good. Offering very good downside protection for its investors, because there is no negative returns in this particular fund since last 1 year. In 1 year, it has given 17.76% return. In 3 years, it has given 25.12% return. In 5 years, it has given 12.43% return. And since inception, it has given 14.07% return. Imagine if you would have done a 10k of SIP in this fund for since last 5 years with a step of 10%. Then by now your investment would have been 10.88 lakhs. Means the total value of the portfolio would have been 10.88 lakhs with a profit of 4.88 lakhs, and your annualized return would have been 23.65%. If you compare this with the EPF, which is just 8.10%, with PPF 7.10%, bank FD gives 6%, savings give 5%, and gold only 2.50%. If you compare this fund with the benchmark, that is fund returns versus the benchmark returns, then in July it has given less returns compared with the benchmark, but in August and October it has beaten the benchmark. It has given good returns compared with the benchmark. If let's say you are investing in this fund for the next 20 years and the fund is continuing to give you 14% returns, then in that scenario your investment amount is going to be 24 lakhs. Estimated returns could be 1 crore and 7 lakhs, and the total is going to be 1.31 crores. If you keep on investing in this fund for the next 30 years, then your investment amount is going to be 36 lakhs. Estimated returns could be 5.19 crores, and the total, including the investment amount plus estimated returns, is going to be 5.55 crores. So this was regarding ICICI Infrastructure Fund. Thanks for watching. Please remember, mutual fund investment are subject to market risk. Please note that this video was purely made for educational purpose and there was no recommendation to buy any of the mutual fund mentioned in the video. Please consult your mutual fund distributor before making any investment. The next video is going to be on ICICI FlexiCap Fund and ELSS Tax Saver Fund. Please comment and let us know how did you like our video. Also, if you are new to our channel or if you are not yet subscribed, then make sure that you are subscribing to our channel and hitting the bell button next to it. That's all in this video. See you in the next video. Till then, take care.